video clip, we're going to account for a few transactions related to the non-current assets. Remember that the non-current assets that we have in the campus bookstore are the furniture and equipment and the software. So let's start first with the depreciation of the furniture and equipment. Remember that we purchased the furniture and equipment at the end of year X0, and the useful life that Christine estimated for this furniture and equipment is 5 years. So every year, the furniture and equipment is losing value. Recall that the schedule, the depreciation schedule we estimated in the previous period was the following that you see on the table. So as you see, we take the total purchase cost minus the salvage value of 0, so 25,000 minus 0 divided by 5 years. That will give you the annual depreciation that we need to recognize as an expense and as a decrease in the value of the asset. So by the end of year X1, the net book value of the asset was 25,000 minus the 5,000 that we had recognized as depreciation in the first year. So the net book value of the asset is 20,000 euros. This period, we need to recognize 5,000 euros more of depreciation. How would you account for this? First, we are going to credit the cumulative depreciation. Remember, what we want to do here is to decrease the value of the asset, furniture and equipment. But instead of doing it directly, what we do is to use a different account called depreciation, accumulated depreciation, that subtracts from the original cost of the value. In this way, the advantage of this method is that we always keep track of the original cost and the proportion of that original cost that has been already depreciated. In this way, shareholders know what percentage of the total asset has been depreciated, and therefore, if there is any need to make new investments maybe in the following year. Besides the decrease in the value of the asset, the next thing that we need to do is to recognize that now we are poorer. Therefore, we need to recognize a depreciation expense in the profit and loss account. So we debit the profit and loss account for a total amount of 5,000 euros. Great. So after this transaction, clearly we are poorer because the profit and loss account has decreased, the owner's equity, the net worth of the shareholders has decreased, and second, liquidity has not changed. So actually depreciation, as you can see, is just an allocation of the purchase cost over time. However, the payment of that asset was done in the beginning when we purchased the asset. And therefore, there is a mismatch in time between the payment of this asset and the recognition of the expense over time. Our next transaction is the recognition of the amortization of the software. Remember that depreciation refers to tangible non-current assets, whereas amortization is the same concept applied to intangible non-current assets such as software. In the case of software, we have to recognize amortization of 1,000 euros. Remember that the original cost was 3,000 euros. The estimated salvage value was 0 because this software was becoming obsolete after 3 years, according to the estimation, the subjective estimation of Christine, of course. And third, she estimated the useful life of 3 years. So it's going to be 3,000 minus 0 divided by 3 years. The annual amortization that we need to recognize every year is 1,000 euros. First thing, we credit accumulated amortization. That's going to decrease the value of the software. Second, we need to decrease the profit and loss account. Shareholders are now poorer by 1,000 euros. Okay, we are making progress. Now, let's go for the next transaction. This is a new transaction that we have not seen before, and it's the sale of part of the furniture and equipment. So what happens when you sell an asset? How do you recognize that? So we sell it for a price of 1,800 euros. So that's the cash that we're going to receive. Therefore, we debit cash for this amount. Now, what we are giving in exchange for that cash is an asset that the original cost of which was 5,000 euros. But it also had an accumulated depreciation of 2,000 euros. Therefore, the net book value of this asset is 3,000 euros. So we receive 1,800 euros. In exchange, we are giving an asset with a net book value of 3,000 euros. Now, as you can see here, the transaction doesn't balance. So what do we do with the difference? Well, the difference is going to be, in this case, a loss. Why? Because we have received an asset of 1,800 euros, but what we have given an asset of 3,000 euros. Therefore, here we are poorer, and we need to recognize that in the P&L. So in the P&L, we debit P&L with the loss on the sale of furniture. The thing you need to remember for these kind of transactions where we sell an asset is that we need to estimate always the accounting gain or loss. And the accounting gain or loss will be the result of this formula you see here. So it's going to be the difference between the price that we are getting and the net book value of the asset. And remember that the net book value of the asset is the original cost minus the accumulated depreciation. so the remaining value of that asset. The difference between the price and this net book value is going to be the profit or loss in this operation. Probably you are wondering, why are they selling some of the furniture? Well, Christina told us that actually she needed to change some of the shelves in the store in order to have more books. She's increasing the amount of inventories because sales are also increasing. She wants to increase sales. And so she's replacing some of these shelves for other shelves that have more capacity. This is why the next transaction is a purchase of new furniture for a total amount of 6,000 euros. This one is easy. So how would you account for this? Well, first, we pay this in cash. Therefore, cash is going to decrease by 6,000 euros. We credit the cash account. Remember, for an asset, debit increases, credit decreases an asset. So we credit the cash account. Next, in exchange of this cash, we are getting the furniture. So the furniture account is going to increase. So we are going to debit furniture and equipment by 6,000 euros as well. After this transaction, we are less liquid because we have paid some cash, but profitability has not changed. The net worth of the shareholders is the same. Now, that profitability is going to change in the future once we start next year, to depreciate this asset that we have purchased. Next transaction. So at the end of year X2, Christina felt that she had a lot of cash and she wanted to invest some of this cash while she was not using it. So she decided to purchase some Apple shares. First thing that will happen is that cash will decrease because we are paying this stock in cash. So we credit cash by 15,000 euros. Next, what else do we recognize here? Is this an expense? Well, clearly, we have purchased some stock of Apple, and this has a future value. Actually, tomorrow we could sell this stock in the stock market, right? So we need to recognize another asset, something that has a future value that we own, and it's the result of a past transaction. And we don't have any asset right now that fits this kind of investment. So we need to open a new account that we can call marketable securities. As you see, I'm writing this account very close to cash because actually marketable securities are very liquid. At any moment, we can sell these shares in the stock market and get the cash. So we debit marketable securities by the same amount, 15,000 euros. Note that this purchase has been done on December 31st. Now, what will happen if next year the price in the stock market of Apple shares changes? Well, the way how you recognize financial assets is a very interesting question that goes beyond the scope of this course, but I'm going to talk a little bit about this in the next session. In the next video clip, I'm going to take care of the bank loans and the cost of interest of these loans.